Thank you for watching this video. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, July 8th, 2022. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the developer and president of Simple Market Signals at simplemarketsignals.com. We will come back to this chart in just a couple of minutes, but I want to move over to a weekly candlestick chart of the S&P 500 so we can get a big picture view of what has happened this week and for the last couple of months. So to start off with, the S&P 500 was positive this week, 1.94%, as you can see here. And we've had just 3 positive weeks, 1, 2, 3, over the last 14 weeks of trading. All right, so it's been a pretty rough few months here, but the S&P 500 being up 1.94% this week and closing at 38.9938, right over here where my cursor is circling, as you can see, did close just out of bear market territory. Now, any of you that have watched any of my videos, you know I'm very exact, and I would encourage you to be that way. It doesn't pay as a trader or an investor to let your emotions get the best of you. It pays to be very exact. And a bear market is when you're down 20% or more from your previous high. The previous high back on, I don't have it annotated, I just have it memorized, 48.1862 back on January 4th. That is the all-time intraday high on the S&P 500. Therefore, 20% off of that brings us down to 38.5489. That's why I drew this blue line right here. So anything below 38.5489, and we're in a bear market. Anything above that, we are technically not in a bear market. So the S&P 500 finished just outside of bear market territory this week at 38.9938. And another thing I want to point out here is that we have technically only closed on a weekly closing basis 2 weeks. This one here, 4 weeks ago, and then the previous week. We've only closed 2 weeks below that 38.5489 on the S&P 500. So, we've technically only closed in a bear market for 2, and that's 2 out of the last 4 weeks on the S&P 500. Okay, I'm not trying to minimize the downturn here, guys, but we have to be very exact with our verbiage. And, there's a whole lot of people out there, with the crash verbiage and all this stuff, the sky's falling. Yes, it is a bad market, all right? But let's be exact. Let's be mature. Let's be pragmatic. Let's be technicians, not, super emotional people with, that fall prey and become victims to sensationalized news. All right, there's enough sensationalized news out there. You're not going to hear it from me. All right, I'm going to give you the facts. And with that said, if you are not yet a subscriber, there's over 10,600 people that have subscribed to this channel. Thank you very much. If you're not one of them, please make sure you subscribe so I can continue to share this type of information with you. Now, by the way, this is a 9-month chart, weekly candlestick chart. Okay, I think I pointed that out, but each candlestick does represent 1 week of trading. The chart goes back 9 months on this one. All right, and we can see here, even with this week's positive move, one last thing before we move on to the next chart, you can see I drew a downtrend line here. Having trouble getting that connected exactly, but you get the idea that even with this week's positive move that brought us barely out of bear market territory, we're still in a downtrend, okay? And this was, really, at least for now, this is a counter trend move, and that again brought us barely out of bear market territory. But guys, we're in a downtrend, right? And we've been dancing in and out of a bear market for the last 4 weeks, so we'll have to see what next week brings. But now let's get a little bit more granular, and we're going to move on to a 2-month hourly candlestick chart of the S&P 500. And I like using these hourly charts. I call this putting the market under the microscope. And then, of course, you can do 30-minute, 15-minute, 10-minute, whatever if you want. But these hourly charts allow you to see some things that you just can't see when you're looking at a longer time frame. Okay, so again, a 2-month hourly chart of the S&P 500. I have several lines here. Let's start at the top and work our way down. So we had a breakout above this 3980 line back towards the latter part of May, the last week of May, and we had about 2 weeks of trading above 3980. But as we can see, we have had no trading above 3980 since June 9th. Okay, that was the last time that we've had any trading at all above 3980. The last time we've had any hourly closes above 3940 was June 9th, right here, right? And then we had 1 hour right here. I just want to underscore this, guys, because it's super important for you to understand this. We've had, less than an hour of trading above 3940 over basically the last month, all right, going clear back to June 10th. Now, the market fell all the way down to 36.87, as we can see here on March 17th. So we have at least a short-term bottom that has been put in on this market, on the S&P 500 at 36.87 back here on March 17th. And as you can see, we've had this upward trajectory here. But it's more than likely a counter-trend rally. And just like these other counter-trend rallies, guys, I'm going to go back to the longer-term chart, but, we've had a counter-trend rally that failed. 1 week failed. Had 3 weeks, failed. Another week failed. Another week failed. So more than likely, what we're experiencing here is a counter-trend rally that will likely run out of gas. And this last move here over this last week, we couldn't even really get above 39.20, no line, but you can see where my cursor is circling, all right? But you can see with this 39.40, and this is why it's important for you guys to understand this, even on the hourly charts, this 39.40 is acting as overhead resistance, okay? Now, one slightly positive thing that I'm seeing here in this chart is a cup with a handle formation right here. You can only see this on these hourly charts, all right? But there's a cup with a handle, and that can be a very, very powerful, powerful formation. But in order for this thing to work, we would need to break out to the upside above 39.40. So if for whatever reason there's some positive news or some catalyst that continues to drive this market higher, one positive thing we would see on the charts that would corroborate that would be a break above this 39.40 line and really back above 39.80, but definitely above 39.40 sometime next week. Because if we falter for any length of time, more than likely we're just going to roll back over and find ourselves underneath this 38.30 level, which I'll talk about here in just a second. All right. So in order for this potentially powerful cup with a handle formation to work in our favor to the upside, again, a breakout above 39.40 and then 39.80, because there really has only been 1 hour where there's been any trading between 39.40 and 39.80, going clear back to May, right, to the last week in May. So other than this 1 hour on June 10th, there's been no trading really to speak of between 39.40 and 39.80 until we, unless we go clear back to that last week in May. All right. So these areas, the reason I'm drilling down on this, right, when you're looking at support and resistance levels, you have to look at where the market has traded. And when you have, virtually no trading for months, right, for almost several, for a month and a half in this area, it's just, there's not much there, right? So conversely, though, if we get above 39.80, we could above 39.40, we could pop above 39.80 fairly easily because over the last, month and a half, there just hasn't been any trading in that area. All right, so hopefully that all made sense. Again, it's just, when you're doing this analysis, right, it's kind of up to individual interpretation. I've analyzed thousands and thousands of charts over my decades of being in the markets and being in financial services. But if you're seeing something different, that's great. Okay. Now, this line here, all right, and we kind of looked at it on this this chart here, talked just a little bit about it, but this is that 38.54.89 bear market line. That's this one here. All right. The lower line is 38.30, and you can see 38.30 goes clear back to May. We came down and stopped, didn't have any hourly closes at least on this 2-month chart, below that 38.30 level back in May, kind of bounced off of that and went all the way up to the 41.80 level before we got rejected and fell down. And you can see that once we gapped down back here in the middle part of June, most all of the trading, with the exception of a few days, has been below this 38.30 level. All right, so that 38.30 level definitely acted, as we can see here, right in here, acted as overhead resistance. All right, so prior resistance becomes support once penetrated to the upside. So this 38.30 level could, much like it did here, act as at least temporary support if the market does start to roll over anytime soon. So that would be an area to watch. But again, if we fall below 38.30 anytime soon, then that once again becomes overhead resistance. Okay, so guys, there's nothing easy about these markets. To me, this just looks like a counter trend rally. It's not it's not unusual to have a rally in the middle of the summer, but also keep in mind that we are getting closer to the worst 3 months of the year, August through October. So, if you are trying to play the long side during this counter trend move, just be careful, because these are very failure prone moves when you see these things. Now, if we start to see a break above this trend line and we get back above 4,000, then the markets could definitely go higher for a while. It's possible. All right, I don't know how probable it is, but I would definitely, if we're going to see something that's going to last for a few weeks to the upside, we would definitely want to break this downtrend, and that would put the S&P 500 back above 4,000. But, and again, that would get us back above, obviously, this 39.80 level and back into this level that we traded in for a couple of weeks between 39.80 and 41.80 on the S&P 500. And again, we traded there for a couple of weeks from the end of May until the middle of June. Are you a business owner or a busy executive, including a doctor, dentist, attorney, or realtor? Do you manage any of your own money, including in your 401k or IRA? Are time and money important to you? If time and money are important to you, then simple market signals should be important to you as well. Simple market signals is for business owners, busy corporate executives, and other professionals who want to cut through the stock market BS and get down to the facts. If you value your time, if you value your money, you need Simple Market Signals. Simple Market Signals is based on a proprietary formula developed by a former financial services professional with decades of real-world experience. Simple Market Signals is equity investing information simplified. Simple Market Signals saves you time and helps you understand market trends and risk management in a way few enjoy. Just try it. There's no contracts. You can cancel anytime, and a subscription to this information is less than 67 cents per day, and it's priced way less than it should be for the value it brings. To learn more, go to simplemarketsignals.com and watch this video that's on our homepage. So again, go to simplemarketsignals.com and watch this video that's on our homepage. Again, that website is simplemarketsignals.com.